Well, thanks for tuning into Talking Point. I'm your host, Niraj Shah. The new year couldn't have started off better. We had a fairly decent start to the trading year with the first day of the year when we are amongst the few markets which are operational. But on the whole, we seem to be continuing the momentum in the very early days. Of course, too soon to say, but we seem to be continuing the momentum on world equity markets and Indian equity markets at large as we enter 2021. And well, it's great to be talking to one of the largest category 3 AIFs in the country to get their sense of how they're feeling about 2021 now that we are no longer at those abysmally low levels, but perched at all-time highs. Andrew Holland of Avendus, and needs no introduction really, but joins in today to talk about his thoughts on how he feels about the markets. Andrew, good morning and a happy 2021 to you and team.
Yes, and Happy New Year to you, your team, and all the viewers.
Thank you so much, Andrew. Just correct me if I'm wrong. You guys are still the largest, if not amongst the largest category 3 IFs as we speak, right?
No, we remain the largest. Yeah.
You remain the largest. Okay, great. So, Andrew, just how are you feeling about the momentum in the equity markets thus far? Is it more of the same, or are there other variables that have come into play?
I think in the short term it's more of the same. I mean, if you look at where we are in terms of the number of cases globally in terms of COVID, it's at the same or even worse than it was back in March. Now, obviously, the difference this time around is that you've got a vaccine, and so there's a lot of hope that will kind of bring immunity, towards the second half of the year. So that's the big difference. But what that means in the very short term is obviously those economies like the US, Europe, and UK are continuing to suffer from the kind of many various kind of extended lockdowns. So that means that central banks and governments will continue to throw money into the problem. So for at least the first quarter, we can see this kind of monetary kind of easing and stimulus packages towards the economy continuing. So that sets itself well for continued kind of liquidity-driven markets, at least in the first quarter.
So we may try to throw various reasons, Andrew, at why the markets will do well. You reckon the overarching reason is liquidity?
Well, I think that's the very short term, but if you look at some of the long-term things, or some of the things we talked about before, is that our view is, the dollar will get weaker because obviously the Fed will be compelled to keep interest lower for a lot longer. Anyway, they've said that to keep the interest burden down. So when investors in the US and elsewhere look for growth and yield, then obviously Asia fits both those bills. And in that respect, what I think will happen is that flows will continue to emerging markets, but particularly towards Asia, because I think Asia-led growth, by China in particular and India, will be for the next 4 to 5 years. I mean, if you just take millennials, for example, as the next kind of form of spending power in terms of the hands of people. Then, there's 60 million or so in the US. There's 300 odd million each, respectively, in China and India. So where the big growth patterns are coming from in the future. So I think the flows towards emerging markets will be Asia-led, and India, because of its weightage, will obviously get our fair share of that of those flows. So it's a kind of a little longer term. In terms of our thoughts on the kind of flows coming into to emerging markets, because of the growth patterns that we'll see over the next 5 years and more, led by consumption.
Yeah, that's interesting. And there's this wonderful chart on Bloomberg which also showed how, as much as we like to speak about the recovery in the US markets, Asia interestingly is pulled ahead of the S&P 500 by a whisker. But in 2020, Asia has actually done better than S&P marginally at that. But having said that, Andrew, I heard you mention that over the next 3 to 5 years, you reckon growth led by consumption will drive earnings, I'm presuming, and therefore flows into the country as well. So that's a very long-term view. What about the slightly near term? We are at the cusp of an earnings season wherein after Q2 surprises, the expectation must be a bit higher. We also have the budget wherein the finance minister is in various forums has kind of said that the budget will be something that people might not have seen, and they have invited suggestions, etc., etc. Do you reckon that the near-term triggers from earnings, from budget, from government spending and schemes, etc., will keep these elevated levels in play?
I think it will, partly because, the earnings season, which will be kicked off very shortly by the IT companies. I think you'll see some great growth from those, from that sector in particular. And, the operational gearing of India, as we talked about many times, both on the upside and the downside, is significant. And because they've been able to contain costs in last quarter as well, then I think you'll start to see, or you have been seeing earnings upgrades, and I think that will continue. So I wouldn't be surprised if in the I'm talking about calendar year now, earnings should be growing at 20 to 25%. And don't forget, the GDP forecasts also, whilst a negative, have been brought down from those to 10% levels to say around -6, -7 for the year ending in March. And thereafter, I think most economists are looking for anywhere between 8 to 10%. So we're seeing real growth from the pre-COVID levels in 21, 22, and that'll be one of the few countries that do, because a lot of the rebound, I'm saying the word rebound, really takes most economies back to where they were pre-COVID levels, and that's why I'm saying this growth, from Asia. Will be significant and be the growth engine of the world going forward. So therefore, you can see this consistency of earnings upgrades over the forthcoming year, which we haven't seen for some time. So for the first time, for a long time, India might justify some of these high valuations by earnings upgrades, and I think that's what the market's baking in, and I'm okay with that, because I think that's what will happen.
Okay, well, for a bull, Andrew, that's music to the ears. Just one quick follow-up question. We had Shankar the other day on the same show, and he was saying that we're making a meal out of what India has done, but some of the other countries have also done so, etc., etc. So his argument was that India is not alone, which is fine. The only question is, even if other countries are getting money, and you would have a great sense of what's happening, right? Because you have an eye on what the world is doing. Even if the other countries are getting money, should we bother with relative comparisons, as long as for an Indian investor on the absolute term, money keeps on coming in and the prices keep on moving up?
See, relatively, you're going to have these pockets where countries will do well. So, for example, if we are saying that the global economy is going to rebound anywhere to between 3 and 5% next year, or sorry, this current year now, then one of the proxies on global growth is South Korea. So you would expect that flows to South Korea would be very strong, because they're an exporting country, and would do very well in that scenario. And global trade, hopefully under President-elect Biden, will be a little less fraught with problems than it was under President Trump. So all of that bodes well for a country like Korea, where valuations are also quite reasonable. So you will see flows going towards that. But as I said, because I think the flows to emerging markets will be more Asia-led in terms of the skew towards Asia, India's weightage at 9%, we're going to, even in a neutral stance by an emerging market manager, would see that flows would come to India. But I think the point I'm trying to make here is not just foreign investment flows. I think foreign direct investment flows will also come to India. I think Reliance did a great job last year in putting India back on the growth map, and that's really helped us. And the pharma industry, because of manufacturing vaccines, again has put India back on the map in terms of manufacturing. So you will get foreign direct investment flows as well, which is also very good for the country in jobs and in terms of expansion of certain industries. So I think all that kind of bodes well. So I wouldn't be too worried on a month-by-month basis about our flows, unless there's kind of a risk-off trade. But I think we'll get our fair share anyway, because the momentum is there. And I think the other point to be made here is that if you're looking at a broad-based economic recovery, then the likes of China and India, in terms of the broad-based number of sectors that we have and the market capitalization compared to other Asian countries, can only really force investors towards, the likes of China and India going forward.
Okay, well, that's heartening to know. The other bit is, Andrew, we're seeing some telltale signs of this, this recovery signs already coming in, right? I mean, there's this chart which spoke about the monthly port volumes, which are already moving up. And I think the release today by Adani Ports seems to suggest that they've handled the highest volume that they have handled in a long time or ever. Are we already, the point that I was trying to make was that the first half of the recovery since March was dominated by TMT and some of the others. But we've started seeing slight the broadening of sectors participating. Do you think that the next 6 to 9 to 12 months, the economy facing sectors might actually do better than telecom, technology, and the others, which were not so brutally decimated?
Yeah, I think one of the good things about this year will be the broadening of the returns in the indices. Kind of prior to last year, it was really kind of a handful of stocks, and that's been a global factor as well. But I think as we broaden out the economic growth, then the real sectors which will perform, in our view, will be the banking, energy, industrial, and consumer discretionary sectors. We think those will be the leaders, and obviously that's a broader base for the index over what we've seen in the previous year. Now, don't get me wrong, I still think because of digitization, telecom will do well, IT will continue to do well because of the disruption that you're seeing in various industries. So they will be relatively better than the index, but I think these are the sectors that I mentioned which will be the outperformers going forward.
You like what you see with the monthly numbers from autos, for example? They've just come in over the weekend. What do you think of that, and what does that point towards? And part two of my question is this whole month by month price increases that are happening with steel or metals, for example, and commodities. What do you think about these two? Because they seem to have kind of caught the investor attention.
Yeah, and see, on the commodity side, again, two factors there. One, if the global economy is recovering, then obviously, demand for commodities is going to rise. And it's not as though, the rises are anywhere near, their peak. So there's still a lot to go for in the commodity sector. The negative part of that, obviously, is that whilst, a lot of sectors, like the auto sectors, have benefited from lower prices for a prolonged period of time, they will get this pressure now on terms of margins, which they're going to have to try and pass on. So, I think in the short term, the auto sector will continue to do well, but those margin, might be compressed going forward. So you might not see as large a growth in terms of profitability than we have seen in the past few quarters. But that said, you're going to see record number of sales. So you can get in the volume, then it can offset some of the price increases from your input products like steel and elsewhere, which will help the auto industry. But I think overall, after this quarter, I think the earnings momentum may slow because growth may slow. That is because I think the input costs are starting to rise, and I think what will happen next is obviously people will start spending more on advertising and so forth and so on. So the margin compression will be there in the next few quarters, but not enough to stop your kind of earnings growth still of 20% because of operational gearing impact, that which I mentioned before.
And just the nature of the rise has been so parabolic. So actually, it's not been parabolic, but allow me to use that term. My question is: are you do you guys think of booking profits or buying safety in any fashion whatsoever when it comes to India, purely India? I'm not talking about the global market. purely Indian markets. Do you guys think of doing that at all, or are you comfortable staying long? I don't know if you guys do leverage longs at all or no, whether you're the permits, etc. But can you throw some light out here?
No, so we always keep a hedge against our long positions, and obviously that's obviously actively managed because they have sector rotation and so forth and so on. So that's always going to be there for us in terms of you never know when a market fall is going to come, so you have to have some protection there. So we're managing that on a day-to-day basis. I think there are risks. I've given you a kind of a Goldilocks scenario so far. But there are risks out there. The market's ignoring them at the moment because of the sheer amount of liquidity. But obviously, if there's any delay in the kind of vaccine rollout or any kind of side effects of the, hopefully not, of the vaccine, would be a real big dampener for the global economy and expectations that the growth would pick up in the second half. The second point is, let's say that all rolls out very well, is that inflation could come back a lot quicker than people are expecting going forward. Because if you get a weaker dollar and the US is recovering, then they're importing inflation. So you might just see that inflation picks up more. The worries about the Federal Reserve having to increase rates, which would be horrendous for a lot of companies. Still, hugely amount of debt that they have. So these are the kind of risk factors which I think the market's ignoring. In the very short term, there's that one vote in for the Senate, where again, if the Democrats were to win, the market's is discounting that they won't. But if they do, then maybe there's thoughts then that tax increases maybe a little bit to be rolled out a little bit more quicker than they would do under Republican Senate. So those are kind of things that the markets are trying to ignore at the moment, but they're going to be there, and it's going to be more volatile. I think the vaccine rollout and the success of that, will lead to our expectations of how we see the economic global growth, following through, in terms of the second half of the year expectations. So we have to watch that in the next 2 months. My hope would be that the vaccine is, there's no disruption and things get back to normal. And of course, then the narrative comes back to, what are we going to do once we feel we can get back to normal? Will we continue to save more in case it's because of a rainy day, or will we just go out and start spending? So I have no experience of that because I wasn't there in the 20s, but when it happened. But if anything to go by what happened when the exit started happening in Europe and the US, people very quickly wanted to get back to normal. So I do see that people start spending money a lot quicker, want to get back to their experiences, will want to get back to services, luxury, restaurants, pubs, whatever they want to do. And that could spurt growth a lot quicker than the market's expecting, therefore fueling inflation as well. So those are the things. So we might get back to normal, but it might also have some side effects as well in terms of inflation. But that's so the narrative towards the roaring 20s is going to become louder and louder, I think.
Well, if you had been in the 20s, Andrew, then it would have been clear for you to be here and giving me this interview as well. You would have looked a lot older. but anyways, so Andrew, just one quick follow-up. I hear nobody talk about valuations at all. I mean, that word valuation is just not uttered in columns, in interviews, etc. Is that put on the back burner because of the force of liquidity?
I think there's a few things I think about in terms of valuations now, because obviously, I could, the easy way to say is valuations are high, markets are overbought, which they are, right? I feel that way. But I feel that there's because of the disruption that we're seeing across many industries, then you're really looking at growth stocks going forward. I think the value stocks, will remain under pressure for some time now until you have what I would call a more fully blown kind of economic recovery and markets kind of getting to beyond where we are today. So I still think it's going to be the growth stocks which will lead, and I think that's where the market, anyway, prior to COVID, was focusing its attention, if you could see, it was really those handful of stocks, which would be not just disrupting, certain industries, but would have very strong kind of tailwinds of growth over many years. And I think that's what the market's looking for now. So maybe I'm not saying that we should ever forget about valuations, but I think in the shorter term, there's this shift towards growth and sustainability of growth. And I think as we go forward, ESG type principles will continue to be brought to the fore, and that will again kind of lead us to a smaller number of, I'm talking about large caps now, a smaller number of large caps which fit that bill. And whole industries are just going to kind of be derated, and other industries. So if you looked at the oil index, renewable energy has massively outperformed, the oil stocks over the past 1 year. So you're getting this differential within sectors as well, partly to do with ESG, partly to do with growth momentum, which I don't think the market, is quite ready for. In terms of, I'm looking at, as you are, and saying valuations, but there's a change going on, which is causing this. Now, we will go back to the mean at some point, but it's not. I don't think it's quite now.
I don't think it's quite now. Okay, Andrew, final question. Do you guys talk of Bitcoin in your meetings about allocating some portion of your funds to crypto and Bitcoin?
No, because we only deal in equities, so we don't. But from a personal viewpoint, I think we talked about this many years back. It's been one of my best performing assets this past year, or past years actually, when I think about it. So I'm not going to say anything bearish about it.
Okay. So if you don't mind, Andrew, and I don't know if rules or whatever your internal rules allow you, but since it's a personal thing and not a fund related thing, can you talk about the logic or the rationale behind crypto and Bitcoin? What prompted you, or what prompts you even now to hold on to your investment?
So what prompted me, a number of years back now, was the fact that it was more to do with what I thought would happen in terms of technology and how we might change our patterns of using currencies, and I felt it was something that the younger people would take to more than maybe me, which I probably wouldn't use Bitcoin as a payment until it's really well established. So it was really a kind of a view that would be the trend over a very long period of time. And I think what's happened in the past 6 to 9 months, it's become more mainstream in terms of some of the big hedge funds, investors. I mean, Fidelity has been a big investor in it from the very beginning, and put some credibility behind it. But now you're seeing all the kind of big Wall Street brokers now, having forecasts, very high for the coin over the next the Bitcoin over the next few years, partly as a result of what's happening to the dollar, and maybe as another hedge against the dollar fall rather than using usually gold. So I think the fundamentals are looking better, but it's more to do with I suppose the acceptance by the mainstream that Bitcoin is here to stay, and it can be used in the future, for payment of goods, and maybe that's the next big disruptor in terms of how you pay for things. I'm not sure. I just believe that the future is probably some kind of different form of payment system, and Bitcoin's obviously the leader in that at the moment.
Got it. Thank you so much, Andrew. This was a lovely conversation. I look forward to, of course, talking to you sometime soon. But thanks for taking the time out today, and wish you and yours a very happy 2021.
Yeah. Thank you, and wish you all the same.
Thank you so much. And viewers, thanks for tuning into this edition of The Talking Point.